Today we explore how equity works. 1. How equity works in Australian property. Equity refers to the difference between the value of your home and the amount you owe on your loan. For the banks, this difference, along with their safety lending margin, determines how much you can borrow. For instance, if your home is valued at $1 million and you owe $500,000, a bank allowing an 80% loan to value ratio means that you could potentially borrow up to $800,000. And in this example, means you have access to $300,000 in equity. You can utilize equity for various purposes such as installing a swimming pool, buying a car, and most commonly to buy an investment property. Many investors leverage this strategy to acquire another property without the need for another deposit, effectively borrowing the entire purchase price plus associated costs. 2. How to use equity as a deposit. Imagine you're looking to purchase an investment property in Queensland valued at $700,000. To meet the 20% deposit requirement and cover all associated costs like stamp duty, you need approximately $170,000. With this in mind, we can examine your equity position in your current home to determine whether it can be used to fund the deposit for the new purchase. And going back to our previous example, we know that we have a home worth $1 million. And based on being able to borrow up to 80% loan to value ratio, we can leverage a home loan on this property for up to $800,000. With the current home loan being $500,000, it means we have sufficient equity to cover the $170,000 needed for our next home. The utilization of this equity means that our total loan to value ratio would increase to 67% with the new debt. 3. How to use equity to buy another home. There are two main ways you can access your equity. The first is through a loan called cross-securitization, and the second is known as a standalone home loan. Let's take a look at how each work. Firstly, cross-collateralization, also known as cross-securitization, is a loan structure where a loan or loans are secured by two or more properties. This approach allows borrowers to finance the entire purchase price of a property, providing equity permits. Imagine you're interested in buying an investment property worth $500,000. Luckily, you already own a home outright valued at $1 million. Without the use of equity, typically you need to provide the bank a minimum 20% deposit plus having additional monies for such things as stamp duty. However, because you own your home, by cross-securitizing both properties, you can borrow the entire purchase price plus the additional costs, such as stamp duty. This means you could borrow, say, $525,000 to cover all the costs, including the purchase price. This loan amount would be secured by both properties. That's both the existing property and the intended purchase property. So in this example, we have two properties valued at $1.5 million in total. The first property is an investment property we acquired for $500,000. And the second property is the existing home we own for $1 million. Through cross-collateralization, the bank now holds a combined value of $1.5 million in properties. And in this scenario, we are only borrowing $525,000. And based on the equity position we hold, it would mean your loan to value ratio would be roughly 35%. Unlike cross-collateralization, where a loan is secured by multiple properties, standalone securities focus on securing loans with single properties. Let's use a previous example to illustrate this. In this scenario, you would instead need to have two loans. The first loan is $400,000 and that's secured against the investment property valued at $500,000. This loan represents 80% of the property's value, and by doing so allows us to avoid paying mortgage insurance. The second loan of $125,000 would be secured by your home, and as before, you would still be borrowing the total $525,000, but rather it being one loan secured by two properties, you have two loans, each separately secured by two different properties, therefore allowing you to use two different banks if you so desire. Both cross-securitization and standalone home loans would allow you to access the equity in your property, but they do it in two different ways entirely. 4. Accessing your equity. To tap into your equity held in your home, you have two primary options: either refinance your mortgage or increase your current loan through a top-up application. Refinancing involves switching your mortgage to a different provider, while a top-up means you stay with your current bank but increase your loan amount. The initial step in both processes is to get your bank to complete a valuation, which will ultimately determine how much equity is available in your home. It's important to note that the banks use various third-party valuation firms to assess your property's value. Companies like Heron Todd White, CBRE, and JLL are a few third parties that the banks use. Since these firms are independent of the banks, the same firm may conduct valuations for different banks and potentially lead to an identical valuation outcome regardless of the bank. So if you are aiming to maximize the equity release, consider obtaining several valuations simultaneously. A skilled mortgage broker can facilitate this, helping you identify suitable lenders and arrange for cost-free valuations. After receiving the bank's valuation, you'll know how much equity you can access. 5. Lenders' requirements. Following this next step involves applying for financing via home loan application. Complexities can arise because each bank adheres to its own set of equity release policies. As an example, say you have $100,000 in accessible equity you wish to withdraw. This scenario is commonly referred to a cash-out home loan, and banks scrutinize these very closely, especially when the cash-out amount exceeds $50,000. And in these cases, you may require evidence for the intended use. Let's say, for example, you're looking to buy a car using the equity in your home. The bank may ask for a purchase invoice, a part of their process, to evidence where the cash out funds are being used. Each bank's approach to this situation varies significantly, and a great mortgage broker can streamline this, connecting you with lenders whose requirement aligns with your circumstances, possibly even bypassing the need for such evidentiary information. 6. Equity doesn't increase your borrowing capacity. A common question I get asked a lot is, if I have a lot of equity in my home, then why can't I borrow more money? The answer lies in understanding that equity is not the same as borrowing capacity. It's because lenders analyze two key factors when considering your loan application: your capacity to repay the loan and collateral you offer. Firstly, they assess your borrowing capacity by calculating your income minus your expenses. Essentially, the higher your income and the lower your expenses, the more you can borrow. Secondly, collateral plays a critical role. This includes savings, deposits, and equity in property. Many lenders require a 20% deposit for you to avoid mortgage insurance. Let's examine two scenarios to illustrate these principles. Imagine you earn $1 million a year but lack collateral. That is, you don't have a deposit or equity. Despite having a huge income and high borrowing capacity, banks couldn't lend you any money because you actually don't meet their collateral requirements. Conversely, suppose you have $2 million in cash, which means you have ample collateral, but you have no income, zero. While you may satisfy their collateral criteria, in the absence of income, it means your borrowing capacity is nil, ultimately meaning that in this scenario, the bank would be unable to assist you with the loan. In both scenarios, it's clear that collateral and capacity are essential for the loan to be approved by the bank, and it highlights how critical both are. And it doesn't necessarily mean that the more equity you have, the more the bank can lend to you. And if you're looking for a great mortgage broker here at Hunter Galloway, we can help. We service Australia-wide and don't charge a fee for our service. So reach out and call us on 1300 088 065 or visit us online at huntergalloway.com.au. Thanks for watching, and until next time, I'll catch you then.